Hi everyone. So if you have been an investor for any length of time and actually bought something, well, you've probably thought about when should you sell. Selling is the only time you actually get to see the profit you have made. So it is a really important part of investing. Now, regardless of whether we are talking about real estate or stocks, what we don't want to see happen is that we sell right before the investment goes up significantly in value. And what we also don't want to do is have the chance to sell and not take it, only to see the value decline dramatically. So today I'm going to go through my selling strategy, so hopefully you can work out your own selling strategy. Selling is by far the hardest part of investing. Okay, of course, I can't tell you to buy or sell anything. That's totally up to you. But if you have a few rules about selling that you follow, that will help guide your decision. Now, I'm actually going to be talking specifically about the stock market today, as that is more my focus as an investor, but the same theory applies across all investments. And of course, there are a million personal reasons to sell an investment. Maybe you need the money for a medical emergency, or maybe you need it because you live with your parents and you are plotting their death. These dramatic personal reasons are obviously more important than anything. So you need to look after your health and your family's health, so these are the first reasons to sell an investment. Outside of these dramatic personal problems, let's go through the tactics of selling an investment to attempt to get the best return on our investment. Selling is something we really shouldn't want to do. If we sell, well, the investment idea is over. It's really hard work coming up with great ideas. So to sell out of an investment, it sucks. But why are so many people so quick to sell? These are the most common reasons. 1, to lock in profits. 2, to get out while the market is overpriced. And 3, the government or the economy is going to collapse any day now and I better get out. Now, did you notice how these 3 main reasons to sell have nothing to do with the actual company you invested in? The entire stock market is influenced by fear and greed. So it is the fear of losing money that drives most people to sell a stock. Now, I want you to be better than that. Don't let your fear of losing money be the reason to sell anything. In a moment, I'm going to show you a rational, logical way to sell your investments, and these reasons have nothing to do with the economy. There is a real art to selling, and it is fundamentally the most important part of investing because it is the end of your investment. Peter Lynch makes a couple of really good points here about selling in his book, One Up on Wall Street. If you spend 14 minutes on macroeconomics a year, you have wasted 12 minutes. Now, what this joke means is that macroeconomics shouldn't be a part of your decision making. So ignore the overall market, ignore the economy, ignore pretty much everything that doesn't relate to the industry you are investing in. The second quote from the book that I love is, "Don't cut the flowers to water the weeds." In other words, why the heck would you want to sell your best investments and put money into your worst ideas? That makes no sense. If you have winners, try your best to keep your winners. Now, I'm starting with all the reasons not to sell something, because I think this is the better question to ask ourselves. Now, I've written down in my calendar each annual report date for the companies I have invested in. Now, this is a good time to listen to the most knowledgeable people about the company, and that is the management team. They're the ones who are working each day in the company, so they know more than anyone else, more than any of the analysts or journalists. We also invested in this company because we really liked the CEO and the management team in the first place, and we were confident that they wouldn't ruin the company. So after listening to the CEO and the management team, I asked myself my first question: has my investment thesis changed? Back when I made the investment, I wrote myself a few major reasons why I am investing in the company. I call this my investing thesis. And I reread my thesis and see if any of my reasons are now wrong. If nothing has changed, I won't sell. The next question I ask myself is, has the growth rate changed? Now, to do this, I first look at the analyst's anticipated future 5-year growth rates. I then make my own future growth rate based on the financial performance and what the management team have said. If either of these two growth rates are above 10%, that's all I need to see and there's no reason to sell. Now, you might be wondering, why only 10%? Wouldn't I want 20%? Well, it's because predicting the future is just super hard to do. Analysts are completely wrong pretty much all the time. If we looked at 2019 analyst estimates of future growth rates, I bet they are all wrong because of what happened in 2020. So we can't take this as any sort of accurate information. That's also why we make our own decision on the growth rates. I then look at the past few years of revenue and book value growth. If it is in a declining trend, then this could be an issue. And the third question I ask myself is, what is the trailing 5-year average return on invested capital? So now with the new financial information for the year completed, we can find this year's return on invested capital. So ROIC, or return on invested capital, is a great indicator of how good the company is at turning the capital of the business into profitable investments. So essentially, how good the management team are at making profitable new ideas. Now, I am wanting this average ROIC to be above 10%, but a little like the growth rates, fluctuations occur year to year. So I'm not looking for consistently amazing numbers here, just a good, healthy, long-term average. I probably invested in a company that has a high ROIC anyway. So as long as that hasn't turned negative, then the company is doing fine with my money and there is no reason to sell. Okay, so here are 5 reasons I should sell. If the thesis has changed dramatically, then that might be a good reason to sell your investment. Some good examples of this might be, say the CEO and founder of the company has resigned and has been replaced by a new CEO that doesn't have any stock in the company but is getting paid a huge salary. Now this might be okay, but you listen to the CEO and you just feel like he's a bit stupid. That would be a good reason to sell. Another example might be you invested in the company because they made the best graphic cards in the world, but a competitor makes an even better one now that is twice as good and half the price. So the competitive advantage that the company had, it's now gone. So any company's competitive advantage, if that seems to be getting smaller and smaller, well, that is not a bad reason to sell. Now, I would also consider selling if growth rates are declining. Not just one quarter or even 1 year, but a multi-year trend. If the future growth rates are looking weak below that 10% number, then that is a good reason to sell. So if the ROIC percentage is currently below 10% and the 5-year average has been declining badly, then this could be a good reason to sell. But if the ROIC percentage has been declining, but the current year is above 10%, we'll give it another year and check on it again next year. Another reason to sell is you might have a better opportunity. Now, this has actually happened to me in my investing career before. Back in 2015, I sold my entire portfolio because I had a business opportunity to pursue. So if you have an investment that you want to load up on, you might as well go for the far better investment. But make sure it is really significantly better. If it's just a few percentage ROIC better, then look, don't sell. Let me explain with an example. Okay, so you have option A here and it's got a 30% return on invested capital average for the last 5 years and the current ROIC is also 30%. Everything else on your investment checklist checks out, so it's a great company. Then we have option B, which is your current investment. So your current investment has a 6% return on invested capital this year and a 10% return on invested capital as the 5-year average. Well, if this was the situation, I would swap into option A at 30% all day. But let's say in this new scenario, let's now say option A was actually only 10% return on invested capital average for 5 years and the current ROIC is 10%. Everything else on your investment checklist also checks out, so it's still a good company. And your current investment, option B, well, it has a 6% return on invested capital this year and a 10% return on invested capital average as well. So I would stay in option B because 10% ROIC for option A to 6% for your current investment, it's just not enough of a change. You need to use your own discretion here, but don't be changing for a few percentage points, only change for big gains. And the 5th reason to sell is that the stock price has just gone way past fair value. There is a point when the stock price is just too high relative to its fair value. Now, when you invested, you must have calculated the fair value. If you don't know how to do that, please work that out and use my calculator in the description to help you. Now, this is what I look at during the year between annual reports. I consider selling if the price has gone over 2 times its fair value. So here's a real example. I have invested in Google. Currently, I think fair value is about $1,400 a share, based on its current information. So if the stock price was at $2,800, well, that is 2 times its fair value, and this is when I start looking into the growth rates and that return on invested capital. If things look really strong, I'll keep it even if it is at 2 times its fair value. Now you might be thinking, why would you keep something so overvalued? Well, it's because I might be wrong. Actually, there is a good chance I am wrong. I can't predict the future, and I was just trying to get a ballpark figure when I estimated the fair value anyway. So maybe I was a bit out with some of my predictions. So I still probably won't sell. But if suddenly Google starts pushing 3 times fair value, say over $4,000, well, now I have to take it more seriously. Look, not a bad situation to be in. Again, I try my best not to sell. But if the price is getting silly, well, I then hope I have another investment to move into. It is tricky making this sell decision, and I don't have a perfect answer for it yet, but look, here is what I do. So I check if the thesis has changed. I then check the growth rates. I check the ROIC percentage. I then think to myself, do I have a significantly better opportunity? And then I finally ask myself, has the stock price become silly? At the end of the day, again, I try not to sell. I go through these items to make sure I am definitely not selling out of fear, and this checklist really helps. I also make sure I don't look at anything outside of the industry level. So no looking and thinking about the overall stock market, no worrying about the global economy, and definitely no listening to the guaranteed 100% upcoming zombie apocalypse. So keep your head on and make this decision like a rational human. That's the strategy. Now, hopefully this has helped someone out there, and if you have any questions, you can leave them in the comments. And thanks for staying all the way to the end of the video. I will see you next time.